In this session, I'm going to look at one of the most important tools that is used by analysts, especially from the statement of comprehensive income or from the income statement, profit and loss statement, for typically assessing the performance of the firm, which is the earnings per share. So, what I would like to look at in this session is one, simple versus complex capital structure, right? If the capital structure is what do we mean by, first of all, simple? What do we mean by complex? And how does the earnings per share computation differ in these aspects? And even in the earnings per share computation, I would look at the basic EPS as well as diluted. Diluted is something, especially when there is a complex capital structure. So I would like to look at how do I typically compute the diluted EPS, especially if the company is having some convertible preference stock, right? If it has issued some convertible preference stock, or if it has issued some convertible bonds or debt, right? If there is some convertible bond or debt that is outstanding, or if there are some kind of option like features, let's say stock options or warrants, right? Any of these kind of stuff. If the company has any of things, how do I typically compute the EPS, which we call as diluted EPS? And in what cases the changes that can come into EPS because of some accounting stuff, if the EPS changes and all, how does the typical reporting focus on? So these are some of the various aspects that I am going to bring out in this session. So just to get started, it's a very, whenever I'm using the word EPS or earnings per share, we look at it as the most powerful profitability measure per each share, right? It's a profitability measure per each share. What is the net income that the company has generated? Probably a mandatory to be reported stuff for public firms. Of course, for private, there is not too much of a necessity to report the same. And whenever we are talking of EPS, the share per share is primarily from the perspective of common equity. We don't include the preference shares and all as a part of the EPS computation. Now, as I said, first of all, what is important for me when I'm looking at EPS is the current capital structure of the company. Is it simple or is it more complex? How do I differentiate simple and complex? When I'm having no dilutive securities, we say it is simple, which means there are no options. This company did not issue any kind of stock options or warrants, so or any kind of convertibles, convertible preference stock and all. If it does not have any of these and it has just a plain stock, common equity or preference shares, or if it is having a non-convertible debt, then we typically call it as a simple structure. Whereas if all these things are present or any one or more of these things are present, then we treat the capital structure to be complex. Now, any company which is having any one of these elements, which is having a complex capital structure, the EPS which it has to report in its financial statements, it has to report both the basic EPS as well as the diluted EPS. Now, what do I mean by these two? Whenever I am talking of basic, it does not bother about the dilutives. And the diluted or dilutable securities, they are not typically included as a part of the basic EPS computation. So, as the word itself is saying, the net income, right? E is earnings, P is share, per share. So earnings, I take it as net income, but because I should not include the preference shares in it, I'll subtract the preference dividend from it, divided by the number of shares. This number of shares, instead of directly taking as number of shares, I'll take it as weighted average, because what could very much happen is these number of shares need not be constant throughout the year. It might have increased by the issue of new shares or decreased because of buyback of the share. So what we typically take in the denominator always is the weighted average of number of shares that are outstanding. So the weightage is typically based on any new issues happened or any buybacks happened. So that results in the computation of the basic EPS. Whereas when I am looking at from a diluted perspective, see all these things, convertibles. If it is a convertible preference stock, there is an option where these things can be converted into shares. Warrant again is an option to convert it into a share. Stock options, they create additional shares. Now what we typically are saying in case of diluted EPS is compute the EPS under the assumption that all these things are converted into shares. Assume that all these numbers are converted into shares and compute the weighted average number of shares accordingly. Now, if all these are computed into shares, again, some more differences may come with respect to the net income also. We'll try to see them, because a convertible bond, if it is converted into a share, the interest need not be paid. As long as it is a bond, the interest is typically paid on it. But the once it converts into a share, the interest need not be paid. Means in the net income, I will be adjusting with the interest that is typically paid. So at the end, we'll look at the detailed calculations now. But simple logic is, any of this firm which is having a complex capital structure, it has to report both the basic EPS as well as the diluted. Diluted is the new computation of the EPS under the assumption that all these dilutables, especially the options, the warrants, the convertible debt, convertible preferred stock, all these things are typically converted into shares of the company. The EPS, which is the revised EPS, is computed, and that is what we are calling as the diluted EPS, right? So once we take up a few numericals, things become more and more easier for us. So let's try to understand some of these things. Now, first important thing is computation of the weighted average number of shares, right? The denominator, let's try to compute. If everything is fine, no new shares are issued during the year, right? And no buybacks happen during the year, then computation of the weighted average of number of shares outstanding is a straightforward. It's just the number. But if some of these things have happened, that is where the differences in the computation come out. So let me take a small example, right? So I am more interested in weighted average number of shares outstanding. Let me try to take a simple example for that. So let's say a company is having, right? Let's say the company is having some 10,000 or 1,000 new share, 1,000 existing shares. existing shares as on 1st Jan. Right, I'll talk of existing shares as on 1st Jan, let's say 1000. New shares issued on 1st April. Let's say 200 new shares are issued. Now, in this case, if I have to compute the weighted average, a straightforward case, weighted average number of shares, all I will take is the 1000 shares. 1000 shares were there for how many months? 1000 shares were there for 3 months or probably 0.25 years, plus 1200 shares were there for the remaining 0.75 years. So for this period, if I really wanted the weighted average number of shares to compute the EPS, I would have taken 1150. I can't take 1000, I can't take 1200. I'll take the weighted average number of shares to compute the EPS, whether it is basic or diluted. I'll take this as the weighted average number of shares. But the same example, let's say the new shares issued on 1st Jan, otherwise let me take one more case. Existing shares as on 1st Jan is 1000. Right, the new shares issued on 1st April, let's say, is 200. Then 20% stock dividend. 20% stock dividend on 1st July. That is something that has happened. And after that, let's say uh, uh, shares retired, or probably I can say buyback shares on 1st September. How many? Let's say there are 300 shares that are bought back. Now let's say this is what has happened. In this case, if I had to find out the weighted average number of shares, now this is where a slight understanding has to come out. See, a stock dividend. So one thing that I have to look at is whether company has given a stock dividend or stock split. One of these two, if something of these two have happened, then okay, the number of shares are growing in both the cases, but the percentage of ownership is typically not changing. Right, in both these cases the percentage of the ownership is not changing. So I should really not bother about the weighted average, because weighted average is more from a dimension of the percentage itself. So I should not be much bothered about the way the inclusion of the stock dividend, only except for I have to make it neutral across. Now that the simple way for me to work out, especially when there are stock dividends or stock splits that have happened during the year, then for whatever the period I am doing the weighted average. So this is the period, let's say, for which I am doing the weighted average, and the stock split has occurred here. Stock split or stock dividend has occurred here. Now, whatever are the share related transactions that have happened during this period, adjust them with the stock split or stock dividend. And whatever are the events that have happened after that, do not adjust. So that's the first step. And after that, you simply go ahead with the weighted average computation, which means here if I have to do the adjustments, okay, there is a 20% stock split here. So which means 20% new shares, 20% extra shares would be coming, which means the same would become 1200, and even this would be incremented, because anything before that I'm going to increment it. So I'm taking 240 here, Whereas this I will not increment because this is something that has happened after the split itself. Now, if I have to compute the weighted average, it's as good as saying, okay, 1200 shares are there for 3 months, right? 1200 shares are there for 3 months. I can very well write 3. We'll divide the whole thing by 12. So, either I can write 3 by 12 plus 240 shares are there for 1st April to first, sorry, it's not 200. Either I can write it as, okay, 1200 shares are there for the whole year, right? 1200 shares are there for the, either of the ways. 1200 shares are there for the entire year, okay, 12 by 12. Whereas the 240 new shares are there only for 9 months because they are issued on 1st April, and I have to take out 300 shares, right? And this 300 shares, because they have bought back on 1st September, I have to take the weightage of the remaining 4 months. So overall resulting in a weighted average number of shares of 1280. This is what would go as a part of computation of EPS. So whatever is the stock dividend or stock split, even if I had said here the stock split of 6 is to 5, 6 new shares, 6 shares per every 5 shares. So if I am saying 6 per 5 kind of a stock split also, it means exactly the same, and the weighted average computation would typically contain 1280 as the weighted average itself. So this is one important thing. So whenever there is a stock split or a stock dividend, so all those shares that are outstanding before this period, all the shares that are outstanding before this particular period up to the beginning, you make the adjustment with the split or the dividend. But after that period, till the end of the period, any of the stock related changes that have come, we will not make the adjustment, we'll take it as it is itself. So this has to be really considered. And just for a quick workout, either the days wise I can take the actual number of days to do the adjustment, or we can do an approximation to the closest month and do the adjustment. 9 months out of 12, or exactly if I have to go with, then probably 261 days out of 365, but approximated is probably 271 days out of 365, or approximated is 9 by 12. So such kind of approximations can very well be used, but in reality it goes with actual number of days itself, right? So this is what is the weighted average number, and once I have the weighted average number, I just need to subtract the preference dividend from the net income and divide it by the weighted average outstanding number of shares, and that will give me the basic EPS, right? Now if I have to go with the diluted EPS, this is where one single assessment comes into picture. One small assessment I have to do. First of all, every of these potential dilutables, are they really dilutive or anti-dilutive? For each, okay, if there is a preference stock, I have to see whether that preference stock is dilutive or anti-dilutive. If there are options given, I have to really check whether these options are dilutive or anti-dilutive. What does that mean? Any of those potential dilutables, if they are converted to equity, if they are all converted into equity, and after conversion I see that the EPS is dropping, right? After conversion, if I see that the EPS is dropping, then I call those kind of securities as dilutive securities. But if the EPS is increasing after doing their conversion, then I call them as anti-dilutive securities. Only when it is a dilutive security, I should look at including that into the weighted average computation. But if it is an anti-dilutive security, I'll not include it as a part of the computation of weighted average number of shares. So, in general, okay, we have seen that the basic EPS formula, just to revise it, net income minus the preference dividend divided by weighted average number of shares. Now, if there is a convertible preference stock, if there is a convertible bond, if there is a stock option, I have to check whether each one of them are dilutive or anti-dilutive. If they are dilutive, I have to make the adjustment to this formula. Now, if I am looking at convertible preference stock and let's say it is dilutive, means what if this is converted into equity? If this is converted into equity, obviously I don't need to pay a preference dividend on this. So whatever is the preference dividend that I am paying, especially on this convertible preference stock, I'll add it back because that is no more an expense for me because it is converted into equity. Similarly, if there is a convertible bond and let's say the bond is converted into equity and let's say it's an dilutive kind of a security, which means because it is converted into equity, the interest on the bond need not be subtracted to arrive at net income, which means the net income will be much more higher, which would be to the extent of interest into 1 minus t, because the interest is tax deductible. Now it is becoming equity. So whatever was the gain that has come, whatever was the benefit that has come earlier in the form of tax saving, now is no more applicable, which means the net benefit is only I into 1 minus t. So even that part I would be adding it back. And regarding the weighted average number of shares, now we would be seeing, okay, one convertible preferred stock, how many equity shares it is getting converted into, add it up. One for each convertible bond, how many equity shares are getting created? I'll try to go add that stuff. And for each option, the new shares that are getting created, what are the new shares? How many new shares are getting created if all these options are exercised? If all the warranties are exercised, what are the new shares that are getting created? All these things we would typically find out to the computation of the weighted average number of shares, and finally we would end up with that calculation called the diluted EPS. We'll try to do one numerical calculation which will simplify our overall understanding. But any of these things added to the dilutive EPS, they should be dilutive securities. I have to evaluate them separately whether they are dilutive or anti-dilutive. So the denominator will be adjusted for equivalent number of convertible preference stock which get converted into equity, or convertible bonds to how many equity shares they are all getting converted into. All these things I compute separately and I add it to this particular list, right? And especially if this dilutive security was created only in this year, just 3 months back, then even for the computation, I'll not include the whole year, I'll take only the weighted average, which is 0.25 weightage to the same. So that part remains the same, but the major thing for me is computation of these two. But in case of stocks and warrants, there is, or stock options and warrants, there is a slight different method. which we call as the treasury stock method. See, generally, what is happening, let's say the company has issued 100 stock options, and now let's say these options are exercised. If these options are exercised, there is a money that is getting inflow. Means exercise is for a fixed price which is decided at the beginning of the issue of the option. The employee is able to purchase the share of the company. So because he is purchasing the shares, there is a money inflow that is coming. Now what is expected is, what is this treasury stock method is, the company will use this fund that has typically come because of the exercise of the stock options, use this money to buy back virtually buy back the existing shares in the market at the market price. So which means the net new shares will be primarily based on how many new shares got created because of the exercise minus how many shares got bought back using the fund that has typically come in. That net is the result which would be added up to the weighted average, especially when dealing with stock options and warrants, right? And typically also we would see that the exercise typically happens if the exercise price is less than the average market price during the year. Otherwise, it would not be exercised, and what we see is the options go worthless altogether. So we can take one simple numerical, try to understand the overall the impact that is going to be created, right? So let me take one numerical which could include all these things for the computation of EPS. Okay, let me take a few things. Net income of a company, right? Net income of a company, let me take it as 200,000. Then I'll say preference dividend is 10,000, right? It has declared a preference dividend of 10,000, and the number of shares is, let's say, 100,000. So let's say this is the case. Now here I can compute the basic EPS without any kind of a complication. I'll take it as net income minus the preference dividend. I divide it by, let's say this is the weighted average of the number of shares itself. I can very well say that the basic EPS is somewhere around 1.9. Now I am talking about let's say a preference stock or convertible. The company is having convertible preference stock. What is this convertible preference stock that the company is having? Okay, let me talk about number of units, number of shares, of number of convertible shares that are there. Let's say 100 convertible shares are there. The dividend, 8% dividend, and par value, let's say, is around 100 or 1000 is the par value. So when I say 1000 is the par value, okay, what is the preference dividend that is coming out here? The preference dividend that is coming out here is 8% of 1000, that is per share, and there are 100 such shares. So there is 8000 that is coming out in the form of preference dividend. Overall, there was a 10,000 preference dividend, which means some of them, the 2000 worth is not on the convertible preference stock, but on the regular preference stock, non-convertible preference stock the company has given. But this 8000 is on the convertible preference stock. So if at all this gets converted into equity, this 8,000 need not be paid, right? If it is getting converted into equity, the 8,000 need not be paid. So what I can very well check, now I have to understand the conversion ratio. The conversion ratio for me is, let's say one single share is getting converted into 25 shares of equity, right? Let's say we are talking of one single convertible preference stock which is having a face value of 1000, let's say is getting converted into 25 shares of equity. So how many new shares are getting so because of that, number of new shares that are coming up is 25 times 100, which is 2500 new shares are coming up. So the new EPS which I have to look at now is whatever was the net income earlier minus the preference dividend that was there plus the preference dividend which is coming out because of this mechanism, and I am dividing the same with whatever was the weighted average number of shares that were there earlier plus the new shares that have come out because of this conversion process. So resulting in a new EPS of 1.93. The new EPS actually got increased, which means this is what I call as an anti-dilutive security. But on the other side, let's say if the conversion ratio is 50, which means one preference share is getting converted into 50 common shares. If that is the case, the new shares that got created is 5,000 and what I see is the new EPS is 1.88, which is lesser than the basic. Then I'll call this particular security is a dilutive security and I use this into the computation of the EPS. Right, so the diluted EPS now is 1.88, but when the conversion ratio was just 25, because the new EPS has actually gone up under the assumption that this is converted into equity. When I have tried computing the new EPS, I am seeing that the EPS has actually gone up. Then I don't call it as a dilutive, I'll call it as anti-dilutive security and I will not include it as a part of my diluted EPS computation, which means in that case my diluted EPS also would have been the same as the basic EPS only. So that is what we do as a part of the convertible preference stock calculation. Similarly, let's say I have to talk about the convertible debt. Now I need to know the number of bonds that are there. Let's say there are 500 bonds the company has issued, right? Then again the par value of the bond is, let me assume it as 1000, and the coupon on the bond, let's say, is around 7%, and again the coupon, then I can talk of so whatever is the coupon payment, right? I can look at what is the amount of coupon that is getting paid every time. I can look at it as 100,000 multiplied by 7% multiplied by 500. So this much of coupon was getting paid in every period, but because of that much of a payment there is some kind of a benefit the company was getting. So we will try to adjust that. Now what we are saying is the conversion ratio here. Here I can take the conversion ratio. Let's say one bond is converted into again 50 shares. right? When I'm saying one bond is converted into a 50 shares, then I can say if at all the conversion is successful, the number of new shares that are getting created is 50 times 500, which is 25,000 is the new shares that are getting created. And assuming that it is converted, I'll find out the new EPS. Now individually I'll find the new EPS. So because I have to check whether it is dilutive or not. So here what will I do? 20,000 minus 10,000 up to here, that's not a problem. Now I am checking out this. So if at all this is converted into equity, I don't need to pay this coupon. But of course, as I said, in this coupon, only the non-taxable portion of it I would be looking at, because I would be losing the tax benefit once I convert the debt into equity. So let me assume that the tax rate is 30%. Right? If I am assuming that the tax rate is 30%, the numerator is getting adjusted to that, and the denominator is coming out with number of existing shares plus the number of new shares that are getting created, resulting in the new EPS is only 1.71, which means even this is a dilutive security. So this is a dilutive, so I'll include them in the computation of my overall diluted EPS. Even if the conversion ratio is 40, still it is a dilutive. Even if the conversion ratio is 30, still it's a dilutive kind of a security only. So, okay, let me assume it as 30, the conversion ratio, which means it's still a dilutive security. Even this is a dilutive security. So, I'll include both of them as a part of my computation of the diluted EPS for the company. Now, I could also see the stock options. Okay, the number of stock options the company might have created, let's say around 500 stock options are there, right? Around 500 stock options are there, and the share price, I mean conversion price or the exercise price, the price at which a share can be purchased, let's say it's around 25 bucks, but the average market price during this year, average market price of the share, let me take it as 30 bucks. So if that's the case, what I could typically see, the cash inflow, if at all the options are exercised. So 25 bucks multiplied by 500. The cash inflow that is coming out is 12,500. Number of shares bought back virtually using the treasury stock method. Number of shares that are bought back goes as this cash inflow divided by the average market price per share. So 416 shares are bought back, and number of new shares that are coming up into the computation is just 500 minus 416. So even this is positive, so even this is an diluted kind of a security. But wherever I find this price more than this price, then it becomes an anti-dilutive kind of a security. In that case, I'll not include it into the computation of diluted EPS. Now that I know that these are the three things that are there, overall diluted EPS is coming out as, I can start right from here to compute the diluted EPS. The net income, numerator is net income minus the preference dividend plus whatever is the preference dividend on the convertible scenario plus 35,000 into 1 minus T for the convertible bond, and finally, and for the last one there is nothing. because no payment can be stopped or anything. So the numerator, the adjusted net income is that particular number, and in the denominator I can actually start looking at, initially there were these many shares, but slowly we had 5,000 new shares because of the convertible preference stock. We had 15,000 new shares because of the convertible bond, and around 83 new shares coming up because of the stock options. So overall resulting in the diluted EPS to be somewhere around 1.85. So what we did in this process is entirely starting off with each of the potentially dilutable kind of a security, trying to find out whether it is resulting individually, it is resulting in an increase in the EPS or a decrease in the EPS, and only if it is resulting in a decrease in the EPS it would be included as a part of the computation of diluted EPS. Otherwise it would not be included in the computation. So each potentially dilutable kind of a security, this is one potentially dilutable, this is one potentially dilutable, this is one. So each potentially dilutable kind of a security we have evaluated separately and checked out whether it has resulted in a decrease in the EPS or increase in the EPS, which is it really dilutive or anti-dilutive? And only when they are all dilutive, when each one is dilutive, all those dilutive ones we have included into the computation of the final diluted EPS. So from a reporting perspective, the company has to report both the basic EPS, which is this number, as well as the diluted EPS, which is going to be this number. As an analyst, this number forms an important thing to be used because it talks about what if all those convertibles are typically converted into the common stock itself, right? So this is the basic stuff that needs to be comfortable with as far as the earnings per share is concerned, how we compute the basic EPS and how we compute the diluted EPS. All right.